Well, good morning or good afternoon. How's everybody doing? If you could let me know that you can hear me okay. Make sure that we're coming through. Awesome. Thanks, Kevin. Good morning. Debbie, all coffeeed up?
Capsule.
Uh-oh. Uh-oh. Stop filled. That's okay. Because it was already profitable when the stop hit. Thanks, Andrew. Appreciate that. The stop was in a profitable position, so I'm okay with that. Let's get right to it. I am not a registered broker-dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. So if I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading here. So good morning, Helen. We're going to have a little fun today. Always have fun. At least try to, right? So here's all the stuff coming up. We got a few stragglers coming in. Just fine. Just glad you're here. So Inner Circle is a premium online workshop. Our Inner Circle is August 12th and 19th, 7 o'clock Eastern time. The monthly one is the 21st at 8 p.m. Eastern. Mastermind Group, August 13th and 20th at 8. State of the Union Trading. I like that name. I don't know why. If you're all paying attention to the political scene, it's going to be an interesting season, if you will. Very interesting. It's already very interesting. So no matter what side you're on, it's going to be fun. Well, I don't know if I'd say fun, but definitely interesting for sure. Trading You August 15th and the 29th. Monster Market Movers August 28th. The Power Option Plays Monday and Thursday. Covered Call Explorer on Thursday with Trip. Free Online Workshops, Power Hour every Monday at noon. And Trading Coaches Playbook, this one we're doing now every Friday at noon. And then E-Mini Think Tank with Brandon Monday, Wednesday, and Thursday. Of course, you can find us on all the social media platforms out there. And if you're not familiar with me, if we haven't met, see some names that I don't recognize. I've got a few different tools out there. Patterns to Flash, if you haven't experienced it. It's all about technical analysis. Patterns. I've been dubbed the Pattern Whisperer, which is humbling and flattering. Kind of cool. But yeah, it's all about patterns, all about technical analysis. So if you want to upgrade your technical analysis skill, that is a great tool. It's all on demand, right? There's flashcards and quizzes and on-demand video. There's, I think it's 7 or 8 hours of on-demand video. Weekly Whispers we launched at the beginning of last year. And that's basically, I go do my research once a week, Thursdays. I usually wait till after the market, the final update we can get at 4 o'clock or 7 o'clock Eastern time for Omega charts. So get into the update. Then I go do my research looking for patterns. I flip through about 300 charts, give or take, and looking for specific patterns and identify certain patterns and then go create trading plans. So I basically am just funneling down to from 300 stocks down to usually about 20 or 30. And it was kind of a natural progression. I was already doing all the research anyway for my own trading. So like, why not just record it and let you have access to it? So it's usually about an hour. Sometimes an hour and 15, hour and 20, depending on how many squirrels I find. But so yeah, that's every Thursday I do that. So you get it Friday, usually in the morning sometime, mid-morning, well, West Coast time, mid-morning, early mid-afternoon and East Coast time. So then that gives you the weekend to go through it, figure out which trades you like, which ones you don't. It's just my analysis basically. I'm just talking through it like I'm going to here. So, and what I see, what I don't. Pick the ones you want, pick the ones you like, and trade them or don't trade them. Or paper trade them, whatever you do. So this small accounts, big returns one I did, I think a couple of years ago. It's an on-demand class, 2-hour recorded class that was all about how to take a small account and grow it. So, and any account can be small, right? It's all relative. So that's a good sound though. It's a very good sound. I love it. I can't see what's going on, but I really don't care. I might have to turn that off because that's going to be annoying if it keeps going. I want it to keep going, but how do I, there we go. Where did my volume go? There we go. I don't think, if that affects how I sound, let me know. I don't think it will. I think it's just the volume. I think I just turned the volume on the computer off so that thing doesn't keep ringing every 2 seconds. So there's a question, the $1 million question that everybody wants to know, right? Are we in a recession? Does anybody here know? Depends on your definition of recession, right? Because a couple of years ago, people were trying to change it. A lot of the politicians wanted to change the definition and pretend like we weren't in a recession, even though technically we did go into recession for once, for a very brief time. Technically, we're not in a recession, right? Thank you, Kevin. I love it. Kevin says, I'm not. Yeah, me neither. We're talking about the general economy, not our own personal economies, but I love that thought process. That's awesome. Yeah, the funny thing is, I thought I turned that off. Of course, they call right when I get started. And that was actually a phone call I need to take, but it's not that important right now. So let me turn this thing off, though. Thought I'd done that, but I've been forgetting that a lot lately. Yeah, it depends on the definition. The old school traditional definition is 2 quarters of negative growth, right? So in it was 22, I believe we had that. We had 2 quarters of negative growth, negative GDP growth, that is. So technically we're not right now if you're going off that definition. But if you know historically, recessions aren't called until they're out after they're over. And sometimes it's a whole year after they're over. Because even though last quarter, I mean, what was it, just 2 or 3 weeks ago, they came out with GDP numbers, 2.8% growth. But if you notice, especially in the last year or two, the numbers that they come out with, the initial numbers, almost always get revised down. So they come out with a revision, the revised numbers, weeks or a month or two later. GDP, I think, is once a month. And I'd be willing to bet that the 2.8 number will get revised down probably a little bit, if not a lot. But if it's still positive, that's one thing. It probably won't get revised as negative. But you got to understand that recessions aren't called until after they're over for the most part. I mean, the 2008 recession, the market crashed, the real estate was crashing, everything was crashing, right? And it wasn't until I think late 2008, early 2009, when they said, oh, we're in a recession. And it's not we're in a recession, we were in a recession. So historically, they always announce it after the fact because you don't know, right? The data is lagging. That 2.8% is from the previous quarter. So the only way you never know you're in a recession technically, unless if you get good at kind of peeling the onion back and seeing the bigger picture, then you start to see it, right? It just depends. And that's what, as traders, we need to figure out how to do. You got to dig deeper, right? There's the news. If you watch traditional, regular news media, you're going to get superficial, shallow information. That's one of the nice things about the new, social media, YouTube spectacular. I will found a lot of people on YouTube that I really like. They say it straight. They dig deep into the numbers. There's one lady that I think she used to be a part of the Fed. She was one of the Fed governors for a while, but she's not there anymore. So she's been on that side of the fence, so she knows what it's like. So it's interesting hearing her opinion and what she thinks and what she sees. Yeah, it's really, really intriguing. And one thing I just learned the other day, and I've heard him talk about it, and it finally kind of clicked in my head, the unemployment number, which I'm going to dig into this and try to find it. There is the unemployment number that we see now is the U3. It used to be, I think that's what it's called, U3, whatever it is. It used to be the U6 number. It may be J6 or whatever the acronym is they use for it. It used to be measured differently. And that's what's goofy. And that's why you have to be skeptical of data that comes out of the government who is in the business of making themselves look good, right? They don't want to come out and say, oh, and that's the cheesy thing about Jay Powell. I mean, I feel bad for the guy because if he comes out and says, it looks like we're headed into a recession, what happens? Market crashes. He will create the crash if he comes out and says that. So he can't come out and say the things look terrible. So he has to parse his words and he has to sit on the fence and try to pretend like things are good or at least not say things are heading in the wrong direction. Because if he says that, the cliff's there. We're off there. You know what I mean? So, but I'm going to go with U3 and U6. Even if that's wrong, just go with me. So the new number that we see, the unemployment, that 4.3 that hit last Friday, the U6 number, which is the old number, it measures a lot more in depth, right? It measures the people that are employed part-time that want to be employed full-time. It employs people that, or it measures people that have dropped out of the workforce. I don't remember all the data points that he mentioned, but it is a much more accurate, a much deeper look into the unemployment. And it was at, I think he said like 7.6% based on that number. And I need to dig this up and figure out what they are. And I want to see if there's different charts on each of them. But so unemployment is a lot worse than the headline number is coming out, right? And I personally know people that have gotten laid off, or their hours have been cut back, or a whole bunch of stuff. Intel just came out last Friday, or whenever they announced, last Thursday or Friday. They're laying off 15,000 people. A lot of tech companies are laying people off because they can't. And then you got the AI is not paying off like expected, right? .com bubble, right? That's what happened in the late 90s. This .com thing came out. It's like, oh, this thing's going to be the greatest thing since sliced bread. And what happened? All these stocks, a lot of them had zero valuation. They didn't have any revenue. They had nothing. And they're running the moon. And then reality set in, and it's like, wait a minute. Yeah, this thing, we're too early, right? The .com thing is not going to be there. I mean, 20 years later, it's 25 years later almost, it's materialized. But that's what I've been saying for a while about AI. It looks like people are too early to the party. They're so excited about the technology that they're jumping on board ahead of it, thinking it's going to change that quickly. And things usually don't change that quickly. They just don't go that fast. And you got companies that have invested billions of dollars into AI tech. And it is having some benefits, but the payoff is not as quick. The rate of return is not as quick as they expected. So that's starting to fall apart, right? But the data at this point doesn't tell us we're in a recession, but it usually doesn't tell us that until after the recession. It's either over or it's well underway. So, in my opinion, we're in a recession right now. At this moment in time, we are either in a recession or we're very close to being technically in a recession. I would say that the growth is probably negative at this point. That's my opinion, but that's just me. What? I just saw your comment, Steve. Like, embrace it. Like when maybe I shouldn't repeat that. I don't know. I guess I'm trying to figure out the context of what that means. I'm not sure what to make of that, Steve. Sorry. I mean, it's funny, but oh yeah, Karen. I just saw that. Let me try to remember her name. I want to say Dana something. I don't remember. I have to look it up and see. Let me see if I can find it real quick in the history. I will, but if I can't find it quickly, I'm not gonna hunt for it. Let's see if it's on the headline thing real quick in my history. Peter Schiff is a guy I love. He's a guy that tells it straight. SCHIFF, I think it is. And he called the 08 housing crisis. He killed it with that. He shorted the housing market, just like what's his name? Michael Burry. So Schiff gets into deep. He's the one that was talking about the U6 and the J6. Oh, there it is. There she is, at least. Danielle DiMartino. I think I've seen her a couple times on these different. There's a lot of these different ones on YouTube. That's why I like it. It's not. Yeah, Harry Dent. I just saw him interviewed the other day. He's good too. Yeah, Danielle DiMartino. I think she was part of the Fed at one point. She was a Fed governor or something like that. But don't quote me on that. But that's, I mean, one of the nice things about, not only being able to get away from the mainstream media, even though I'm mixed on YouTube because Google owns them, and I'm not a huge fan of Google. It's a love-hate relationship, right? You love the technology, but you hate the fact that they're using their technology to try to push their own agenda. But Oh, which is sad but true. But the one thing with YouTube is that once you watch something, it saves that in your algorithm and starts to show you more stuff similar to it. So, which is good and bad because sometimes I find weird stuff and I click on it and then all of a sudden I start to find more weird stuff. It's like I didn't want to see all that stuff. So it's a catch-22. But uh, so yeah, it's good. It's good to be able to have access to people that shoot straight though, not the mainstream media that again are looking for ratings. That's what their job is, to get your eyeballs and keep your eyeballs on the screen so that their advertisers make money. So um it looks like I jumped ahead of myself a little bit. There's one right there. Are we on the verge of a crash? I mean, is this market going to just get blitzed to the downside? Um there's one I haven't heard. In fact, Gerald, I'm gonna write it down. Caliente? It's an interesting name. I speak just a little bit of Spanish. So my neighbor's wife is Venezuelan. And I said something about, because I like spicy food. I said something about caliente one time and she looked at me. I'm like, what? Yeah, I like things spicy. She goes, it's picante, not caliente. And apparently caliente means something different. It's not, excuse me. It's not spicy, but it's hot. But it's hot in a different context. Like when the lights are off and the doors are closed and it's husband and wife type of hot. It was like, whoa, I didn't know I was saying that. So I've been ordering burritos at these taco trucks saying I want it hot. I want it caliente. I'm like, wow, ignorance showed through. So um anyway. Oh, I didn't write the website down. I probably should. I always like to see new stuff, interesting stuff from different people. So, and then once you find somebody you like, then you can kind of hone in on them. But nobody knows if we're on the verge of a crash. I don't. I mean, I think we are, but the question is when. When does it happen? And we never know, right? And that's part of what I want to talk about today is how do you prepare for it, right? How do you not only, if we're in a bear market, if we're getting ready to hit a bear market, if we're in a recession, how do you capitalize on that? So going back to uh, Kevin's comment is, are we in a recession? The economy might be in a recession, but are you personally in a recession? Because I get comments all the time from people. It's like, you're so negative, be an optimist. And it's like, you know what? I don't have any control over what's going on out there in the real world, in the big world, right? I'm not necessarily optimistic at this point about the economy, nationally. Um, but I'm optimistic about my own personal economy. So, and that's all I can control anyway. So the beauty of the fact that you're here is that we can trade and we can make money on the downside if the market crashes. So, and then what do you do then? Well, you take your capital that you've made and do something else with it. There's actually, no, it wasn't Harry Dent. It was another guy. I don't remember his name, but he's been in real estate since he was a little kid. His dad was in it. And in 08, 09, 010, the 010, I guess it is technically 010, huh? Um, he and his dad went and were just snatching up apartment buildings. They waited for the crash. They saw it coming and they're picking them up for pennies on the dollar because the banks were just saying, make us an offer. They just wanted to get them off their books. And he even said, he goes, we may be coming up on a once in a lifetime type of opportunity to buy real estate and even possibly stocks at dirt cheap prices. If this market does what he thinks it, when you look at the big picture. So I don't see it as a negative thing. It's not me not being optimistic. I'm actually very optimistic. And if you know history, then you know that huge percentage of those that have created wealth do it in bad economies. They get started in bad economies or they utilize the bad because they know how to take advantage of situation. Either they sit on the sidelines and wait till there's blood in the streets, like JP Morgan said. That's what he learned at a young age. When there's blood in the streets is when you buy. So you hoard your cash, you hoard your buying power, you do what you can to keep everything, keep the dry powder there. And then once there's blood in the street, everybody's freaking out and panicking and doing the wrong thing because that's what we as human nature do. We do the wrong thing at the wrong time. Then that's when you go in and buy stuff. So, yeah, something to think about, plan for. adjust for, be ready for. It's essentially what we're going to cover here today. So is it time to shift the bias to bearish positions? I say, yeah. I've been there for 2 or 3 years, even though the last year or so has been fairly bullish in the market. I'm still doing well and, taking some bull positions, but most of my positions are still bearish. And when you talk about the overall market, you got to remember that you got the, what is it, the Magnificent Seven? There is a small percentage of companies that have been pushing the indexes higher. There's still a lot of companies that have been in a downtrend all year. And now they're getting hit even more now. But there's lots and lots of companies out there that are still they're in their own personal bear market. The companies are themselves. Even though the overall market appears to be in a bull market, it's not necessarily, right? And when you get you really weak breadth, right? When there's only a handful of companies that are pushing things higher, that's an indication that the end is near. A bull market, you've got 60, 70, 80% of stocks are all moving higher because they're all making money, earnings are increasing, revenues are increasing, economy's good, people are buying, right? And now we're getting the opposite. This earnings season has revealed that companies, the consumer is weak. Companies are losing. Look at Intel. They just got slaughtered. Worst day since 1987. Laying off 15,000 people because they have to, right? They're getting killed. They're not making money. Or, well, I don't know what their profit is, but I'm sure they're still making money, but it's less, right? And their job as a company is to maximize profits, not just to make a profit, but to make as much as possible. So shareholders want. So what do we do? If we're in the middle of a shift, which I think we are, I've been talking about it for at least 2 or 3 months. The market has been behaving the last 2 or 3 months just like it did at the end of 21, before we got the bear market of 22, where you had big divergences between the different markets. You got the SPX, the Dow, the NASDAQ, and the Russell. And towards the end of 21, I was watching it, and if you sit in front of the computer in the morning time and you're watching things go, and you see it on a daily basis, most of the time, all 4 of those major markets are going the same direction. You could throw the transports in there too if you wanted to. But at the end of 21, they started doing this weird thing where they're going, the Russell may be up one day and then the other 3 are down. And then you have, the Dow's up a bunch and the SPX is down a bunch. So they're not necessarily in tandem. And generally speaking, they should be. If we're in a solid, bullish, normal economy, they should be moving in tandem. But they weren't. And for 2 or 3 or 4 months, they kept doing that. It wasn't a daily basis, but it was frequent enough that I noticed it. And I'm like, wait a minute. And that's an indication that there's a disconnect, right? And the Russell, if you're not familiar with it, is the small cap, right? It's 2,000 small companies. Approximately 85% of the workforce is employed by small companies, small business. That's what the Russell represents. And the valuable lesson I learned after starting at the very peak of 2000, right, and going through the crash, not having any idea we were crashing, and at the end of that, in 2001, 2002, when things started to turn around, one thing people kept saying on the news is that, well, it's the small business that brings us out of recession. And that always stuck with me. Well, the inverse of that is true. So if small businesses, which are the ones that hire, if they start to do better and they start hiring people, since they make up 85% of the people, the employment, then hiring starts to get better. The economy starts to get better. So when the little guys are doing good, the economy's doing good, generally speaking, right? Excuse me. But if the economy's not doing well, then the little guys are the ones who have to adapt first. I say this all the time. If there's a big aircraft carrier out in the ocean and a little 20-foot fishing boat and a storm comes up, guess who's got to head for shore quick? The little guy, right? Because a big storm is going to capsize him. The aircraft carrier can handle it. The Microsofts, the Apples, the Googles, the Nvidias, they got billions of cash in the bank, right? They're the big aircraft carrier. They don't need to turn around and head for shore right away. They can handle a dip. So that is what the Russell represents. And when the Russell is weak, then in my opinion, the general economy is weak. And what I saw in 21 was a breakout, which at the time, for whatever reason, my gut told me it was a false breakout. Russell had been going sideways for a year, and the SPX and Dow and NASDAQ were still climbing. Like, this is weird. Why isn't the Russell continuing? Even though it did rocket north after COVID, it went a lot faster and a lot steeper than the rest of them. So it was a debate between, okay, is it ahead of the rest of the market, so now it's slowing down? Or is this an indication of weakness and the other markets will eventually catch up to what the Russell's doing? And sometimes we don't know until it plays out, right? Well, the Russell broke out really quick. Like, I was like, that just seems weird. And the other markets didn't move that quick either. And I was just like, something just seemed off. I thought it was a false breakout. Sure enough, 2 weeks later, it dropped back below that resistance. And then the bear market started, and 22 was a good year. And it looks like we're in that same position now. The last 2 or 3 months, the market's been doing the same thing. They've disconnected from each other. I mean, the Russell, about a month ago? The Russell and the Dow were bolting north, while the SPX and the NASDAQ were falling off, which is unusual. It's not normal. So you pay attention to those little things. The intermarket analysis could come in really handy. But it looks like we're in the same position as 22, except in 22, we didn't crash. We just basically sold off. I mean, it dropped heavy and then it would rally back. And so we went in a bear market. It wasn't anything huge, right? It wasn't like a falling off a cliff thing. But what do you do if you have bullish positions? We're going to look at each side, bullish, bearish, and long-term portfolio. Like, what do we do with these if we're in a recession and if the market is turning bearish, if the market crashes, how do we handle that? If you have bullish positions, or if you take a bullish position, there's nothing wrong with trading bullish when we're in a bear market. You're going against the trend, though, right? You've all heard the saying, the trend is your friend. Trade the direction of the trend. And that's wise advice. But if the trend is down, can you still take bullish positions? Yeah, absolutely. But when that's the case, when I'm going against the trend, just generally speaking, anytime I'm trading against the trend. So if we're in a bull market and I'm taking a bear position, I'll usually use tighter stops. I'll exit a little bit earlier. I'll scale out sooner. I'll scale out more. I assume you're all familiar with scaling, I hope. Right, where you're getting in or out of position in chunks and pieces. So that'll blow your mind. If you haven't done that before, then try it. Start out with scaling out if you want, but scaling in will blow your mind too. Right, Jennifer? Is that you that was telling me that? Oh yeah, I just saw your comment, Karen. I like bearish positions. Makes the same move a ton faster than bull. Exactly. That's one reason I love trading the downside. Because not only do things usually drop quicker than they go up, but you also get the volatility flip. Like volatility flip. Well, yeah, do you all see the VIX and how crazy it went? It went nuts, right? Went up to like 60 or something like that, which is huge. It spiked. When volatility spikes like that, and this is one thing I put on Trade Watch alerts, is be careful buying options. That's one of the tricky things about options is if volatility spikes, they're going to put a whole bunch of extra fluff, a whole bunch of extra time value into the options to cover their risk. Because when things get crazy, they don't know what's coming next. And it adds risk to the market makers' positions. So they increase a whole bunch of time. So they blow a whole bunch of air in the balloon. And then once things settle down, what do? Whoop, they let the air back out. And it goes back to relative normal. So when things get really volatile, you got to be a little bit more cautious when you're buying options. If you're buying, if you're selling, that's a good time to sell, right? When it's volatile. So one reason I love the bearish side is because if you can get ahead of the move and it moves quick to the downside and the fear factor goes up, not only do you catch the move, but they're going to add time value to your position. And when you're buying it cheap, when it's light volatility and you're selling it when the volatility is heavy and there's extra time premium in there, you're increasing your rate of return. That's one reason I love trading bearishly. I just do. I love trading puts. I would rather buy a put than buy a call for that reason. Not only is it, like you said, it's quicker, but again, your rates of return are typically higher because of the volatility flip. So the lady, Danielle DiMartino, I think it was. So yeah, it was Danielle. I think it was DiMartino. You could probably just Google it, and I don't know how you spell it. I think it was Artino, if I remember right. So yeah, if you have bullish positions or if you take a bullish position. So if you're trading stocks, you don't have to worry about the volatility part, right? So when it's volatile, if you have the capital to trade stocks instead of the options, that might be something you want to do. You might want to shift from trading options to trading stock if you want to take a position. Like when it gapped down, was it Monday? Yeah. Monday when it gapped down big time. If you would have bought an option then, you could have gotten hammered. I saw it years ago when Lehman died in 2008. I remember when that happened. I was sitting in the morning watching the SPY, and it was going to gap down like 10 points. And I think it was only at 70 or 80 at the time. I don't remember exactly what it was, but it wasn't at 500 like it is now. I think it was 700, maybe 900, but it was gapping down like 8 or 10%. Man, I bet that thing's going to bounce. It's way overdone. I went and looked at the calls. I'm sitting there at the open of the market. I'm thinking about buying calls at the open. And then I'm looking at them. The spreads are crazy huge. Like, yeah, that's nuts. The options were, I think they were, I don't remember exactly. It's been a while. I think they were $8 or $15 or something like that. But whatever the case was, the thing gapped. It rallied back almost the entire gap. It was like a 10-point gap. It rallied back like 7 or 8 points. And the options that I was looking at buying dropped by $2 in value. So they put a whole boatload of air in that balloon when it gapped open because of the fear factor. And then it rallied back big time, almost recouped the entire thing. And the market just took a deep breath. It was like, oh, okay, we're good. And they went, sucked the air right back out of it. And I would have lost money. Thankfully, I didn't pull the trigger on it because I'm looking at it going, this is crazy. That spread's too big. It doesn't make any sense. So I left it. But it was certainly intriguing watching it. And unfortunately, Will had that experience on Car a couple years ago where the stock, I don't know if you remember it, it was Hertz, I think, right? It's one of the car rental companies. I'm pretty sure it was Hertz. They went from 180 on earnings announcement to 520 or something like that in like 45 minutes. It was insanity. I've never seen a move like that in my life. And he ended up buying puts near the top. It was 500 or 480 or something like that. It dropped all the way to $300, and he ended up losing money on it. It dropped about 200 points, and he didn't make money. I remember he came into this class. He's like, what's going on? What happened here? I don't understand this. I'm like, oh, man, I feel bad for you, right? Because he picked it about as perfect as you can, timing-wise. And he still lost because the volatility, right? They just loaded the options up with tons of time premium because that's an insane move. Something in 25 years, that's the only time I can remember seeing anything like that in a day, in 45 minutes, literally like 300 points. Nuts. But the premium was pumped up so high that when he bought it, it was just super inflated. And then they but lesson learned. So, yeah. Oh, of course, Jennifer, you're welcome. Scaling, that's why I support. Those are the two things that are the core of everything. Risk reward, right? Because it puts the odds on your side, and then scaling, which also puts the odds on your side, but it allows you to manage your emotions in a way that I don't know any other techniques you can use to do that. Scaling is just one way that it just lets you just relax. So, especially if you scale out, right? You get into a position, you take part of it off the table, and now it's like, okay. You can leave your stop, just let your stop chill out. You don't have to put a tight stop. You don't have to feel like you have to babysit it every second. So, yeah. Let me see if I can find it again real quick, Tej. If I still have it there. Hopefully I can. Should be right here on the screen still. There it is. I think. You bought stock on the dip? I hope so. Well, and that's the thing, just because I mean options you can catch it too. If you do right, it's just there. Thank you, Kevin. Holy cow. I just saw that. Appreciate that. To get me on my phone and get these stupid notifications from Starbucks coming up. It's like, I don't want coffee. I don't go to Starbucks anymore, at least not very often. Um, awesome. Thanks, Kevin. I appreciate that. Cool, Jennifer. Good. Yeah, stocks. Yeah, stock was a possibly a solid move. Depends, but we'll get there. Actually, I don't know if you're doing it for a long-term buy and hold or not, but that was the next thing I want to touch on real quick is that what happens if you do have a long-term portfolio? How do you deal with that and manage it? And there's a lot of different things you can do, right? That's the beauty of options. They give you lots of options, pun intended. Um, that's because I'm an odds thinker. I'm always like, what are the odds? The odds of upside. And that's why the last few months I'm looking at this market going, I mean, it's pretty overheated. Is there really more upside? And how much more upside is there? And this is where I don't understand. I mean, I got family and friends that are invested long term, and that's all they do is buy and hold because they don't understand what we do, and they don't have any interest in it. And I'm looking at it going, okay, let's say it goes up another 10% in the next year, maybe if it does. I don't see a whole lot more upside than that, but there is a decent potential for a 20, 30, 40, maybe 50% drop because of things that are happening behind the scenes. Well, most people don't see it, first of all, because they don't dig deep enough to see it. They listen to the mainstream news and they see the stuff that's glossed over, the headline numbers. That's all they do. They stop right there. Things are just fine. The economy's great. The president said the economy is great. Okay. Anyway, I won't go there. um, but yeah, they just well, and reality is that most people are lazy. They don't want to do the research. They don't want to put the time and effort into it. Obviously, you guys are a different crowd because you're here. If you were lazy, you wouldn't be here. Um, so that's a good thing. So kudos to you. Uh, but if you want to know what's going on behind the scenes, you have to get away from the mainstream media. You have to dig deeper and you have to peel the onion back and you have to see what's actually taking place behind the scenes. And once you do that, you start to see what's there. It's like, whew. I mean, and there's not enough time to go into it today, all the stuff. And I don't have a list of it anyway, but it's in here, but it's not organized well. I just know what I know. And it's like, um, so yeah, but you all need to dig into it yourself anyway. But so how do you protect a long-term portfolio? You can buy puts, right? If you got some capital sitting there, you can just buy puts. You can sell a call. That protects it to a certain degree, right? If you don't believe there's a whole lot of upside left, which I don't, I think there's a higher risk for a big downside move than there is an upside move. Of course, there's an interesting one that you may find is some people who's a Patrick Bet David. He was talking about, and it's something I had never heard before, and it was interesting, a reverse market crash. I'm like, huh? And he went on to explain it, where the market goes wild and crazy to the upside. It's literally the opposite, where because if the economy gets weak and the government decides to just flood the market with cash, then if there's nowhere else to go, people just start loading up on stocks, right? And that's part of the reason we've had this bull market is where do you put your money? Inflation's not, it's killing your buying power. So if you're going to invest somewhere, where do you go? Real estate's overheated. So people are just investing in the market because there's nowhere else to go that gives a good rate of return. A lot of them are, at least. So another thing you can do if you have a long-term portfolio is call it, right? Which is selling a call and buying a put. You use the proceeds from the call to buy the put, which I don't think is bad. Another one I've brought up occasionally is selling deep in the money calls. Trading your stock, holding on to the stock itself, but doing more swing trading with in the money calls because you can sell the calls against your stock, right? Then you're not naked. So let's say you have $100 stock and you think it's going to drop to 80. Well, you could sell the $90 calls that are $10 in the money. You're going to collect at least $10, right? And if it drops to 80, maybe you sell it out 3 months. If it drops to 80, you're going to get a lot for it then, right? If you're selling the 90 3 months, you're going to get probably $15 for it, depending on the volatility of the stock. But if you get $15 for it and it drops off to 80, if you're, let's just say your cost basis was 100, make the math easy. Let's say you buy it at 100 and you think it's dropping to 80. You sell the $90 calls for 3 months out for $15. You collected 15, your cost basis is 85. Now the stock dropped to 80 like you thought it would. You would let it expire, or you could buy it back, right? Whatever the case is. That's a little bit bigger position, a picture. I'm thinking more in terms of, you could also swing trade it, right? It's at 100. Maybe you think it's going to drop to 95. You could sell, a month or two out, $95. You could sell the 95 in the money. You'll probably get $6 or $7 for it. 3 days later, it drops to 95. If you got $7 for it and you could buy it back for 3, you buy it back for 3, you just cashed in for $4, right? The thing you got to be careful with that is if you sell an in the money call, if there's no time value to it, then you risk you take the risk of early exercise. So you want to sell something that has some time value in it, because otherwise they could, if there's no reason for them to wait till expiration, then they can, right? If there's no time value, then they could exercise it right then, which really isn't that big of a deal. If you get a call from your broker and they say, hey, your call was exercised. Okay, well, I don't want to sell the stock, so do an SDS, right? SDS is a same day substitution. So a sell order triggered the same day you say go buy it, the exact same amount, they just cross each other. So no harm, no foul. And there's no, as far as I know, I'm not a CPA, so I can't say, as far as I know, there's no tax consequence. I know that when I was a licensed broker years ago, there wasn't. I knew that. I don't know if that's changed or not, but so. Yeah, it'll be interesting to see what Jay Powell does. I'm almost certain he's going to cut. Question is how much and how big. There's some people speculating that they're going to go have an emergency meeting, but I don't think that's very likely. It's possible, but well, that's good. Used to ride the wave, but now actively involved. Yeah, no kidding. Waiting a long time to recover is no fun. So, but if you have, well, and here's another, I'm going to throw this out there too. And there's a million different ways to do it. Sometimes it's just a matter of kind of triggering the thoughts, right? If you have a long-term portfolio and you don't see a lot of upside, let's say you have, Apple. Buffett just unloaded half of his Apple stock. He literally sold half his position. That says a lot. when one of the biggest, if not the biggest investor in Apple sells half his position, things are and he's got, I think, the biggest hoard of cash he's ever had right now, because he knows the stock market's overvalued. Yeah, if you have an Apple or an Nvidia or a Tesla and you're up a bunch or whatever, you can do a long-term caller on it, right? You can sell out, you can go out a year and a half, and sell the January calls up at a price where you'd be content with, and then buy an insurance policy down below, so that if in the next year things do tank, you have two choices then at that point. You can either exercise your put, right, and sell the stock at whatever price you bought your put option at, or you could take that profit from the put, cash it out, and buy more stock. Now you have a bigger position, and you have to come out of pocket with cash, right? You're using the profits from your puts to add to your position. If you're trying to build a long-term portfolio, I think that's a great way to do it. So it's just a little variation on the wheel of fortune that Rob does. So it's probably the same thing. It's just I don't even know if it's a variation, actually. It's just reinvesting your profit from your put if it crashes, which is a win-win, right? Because now you're getting more stock of a company you like, if that's what your goal is. And again, you're not necessarily even paying for it. You're letting the market pay for it. So, well, you're far better than I am, Steve, because if you understand half of that, I don't even know if I get 10%. Wait a minute, which one are we talking about? We talking about the official president or the quasi president? The word salad one? Not supposed to go to politics, but yeah, that's sometimes that's all it takes, Jennifer, is just planting the seed in your mind and go, wait, I can do this. Yeah, and just swing trading the stock. If you own a stock, swing trading it within the money calls. that, like I said, the only thing you have to be cautious of is make sure that there's some time value in the call. So you want to go far. If you do like a weekly, that might get exercised early, which shouldn't be a big deal. Double check with your broker and make sure you can do it STS and there's no tax implications, especially if it's something you've had for a long time. Yeah, there's a million different ways to do it. And it's just get creative and think about, okay, how can I protect this stock? I want to own the stock. I want to keep it. I don't want to sell it. Maybe you do have, a massive gain and you don't want to pay taxes on it. Okay. Well, then keep the stock and just protect the downside in one way or another. Swing trade it with in the money calls. Heck, you could do in the money call. If you're that confident that it's gonna drop, then sell in the money calls and buy puts. Use the capital from that to pay for the puts. Right. And if it does, you get a double whammy. It's actually a synthetic short is what that is technically called, if you're not familiar with it. There's synthetic long where you sell a put and then buy the call. Right. So you're selling a put, which obligates you to buy the stock if it goes below a certain price. You use the funds from that to buy a call. And then if it goes up, your put goes down in value, your call goes up in value. So it's similar to buying the stock itself. It's basically a synthetic long, which a caller is not much different, really. It's a synthetic short, essentially, where you're selling a call and buying a put. But if you own the stock, it's called a caller, and potato, right? So moving on. Holy cow. It's already quarter till. No wonder my coffee's cold. So what to do with bearish positions? If we're in a bear market, and to me it appears we're entering one right now, we're heading into one as we speak. I may be wrong. I mean, this thing could recover, but when you look at the earnings that have come out, the things that most companies have said, it's not looking good right now. The economy is getting weak. There's no doubt about that. The question is, how weak will it get? How bad will it get? And how big of an effect will it have? So, and that depends on who you talk to and who you listen to. I think we have a once in a lifetime opportunity coming up. So, and that's part of the reason I wanted to touch on this today, is because it's better to be prepared for it and take advantage of it than not. Right? Why not add to and grow your wealth even more when everybody else is freaking out and panicking? Because when you have plenty of cash in the bank, you're kind of relaxed usually, right? You're not worried about paying your bills every month. So it's a good feeling to be in that position. So on bearish positions, it's pretty much the opposite of bullish positions. So if we do continue, the bearish move continues, then I usually have looser stops. In 22, I had looser stops. We were in a bear market. It was heading south. And that's the other thing too, is volatility in bear markets can get crazy, right? Partly because you have short covering rallies and bottom feeders. You have the people coming in that think that they don't realize we're in a bear market. They think, oh, it's just a dip. Buy the dip, buy the dip. All the people in 2020 and 21 that got in, right? When the pandemic hit, they're sitting at home, government's just giving them cash, saying here. And then what are they going to do? They're not working. So they all started trading. And that's part of what created the bull market, right? Government's handing people cash. They're piling it into the market. Market's going crazy at the upside. And they're all making money. And they're all geniuses, right? Goes back to the old saying, don't confuse brains for a bull market. Or it's the other way around, whatever it is. You know what I mean? And all these people thought they were geniuses. And then 22 hit. And guess what happened? They all went back and got their jobs because they lost all their money back, which is what happened in 2000, right? A lot of people got in the late 90s. 2000 happened and they all got wiped out. Most of them did. So, but those are the bottom feeders, right? We go into a bear market. People don't think we're in a bear market. They're still buying the dips, right? You got a lot of these big funds. You got the people that are working, they have their 401ks. They're putting a certain amount every month away. So there's always going to be these rallies, but you also have the short covering that comes in too. So when a stock falls off, any swing traders, short-term traders that have shorted the stock, and there's a lot of funds that do that too. Most of them don't, but hedge funds will as well. If they short a stock and they're up 10, 20%, what are they going to do? Like, hey, I'm going to take my profit. So they buy. Well, if you buy to cover, then that creates buying pressure. So you got bottom feeders coming in, you got short covering rallies. So a lot of times the moves in a bear market back to the upside are extremely violent. They can be, especially if it's a big move to the downside. Because you have the people that are waiting, sit on the sidelines waiting for an opportunity to buy, and then you have the short covering that happens too. So you get this double whammy. So just realize and understand that when we go in, that's part of the reason for using a looser stop, right? Because you're going to have these big swings to the upside. But that's also where getting back to scaling a little bit can come in really handy, because okay, we just had a big move to the downside. Let me take out half my position. Let me take profit on half of it or a third of it, or it depends on how big the move is, right? I don't have a static number. It's always based on what the chart and what the movement is doing. If it's moving big and it's moving heavy, there's lots of volume, there's lots of momentum. Okay, that's the next bullet point, actually. Scale out if momentum slows. If you get 2 or 3 days of a big giant drop and the volume gets lighter each day, or maybe 3 or 4 days, and the volume starts to get lighter, the momentum's slowing. Scale out, right? Take some off the table. Take a little bit here, a little bit there. Maybe take the whole thing. If you think it's going to bounce big, you can take the whole thing out. The purpose of scaling is because you know what happens? You get in that position, you're like, okay, good, I've got a good profit. I'm good, I'm going to take it. You take your whole profit, you take everything off the table, and then what happens? It keeps going. And you're like, you're freaking out. Why did I get out? You're kicking yourself. You want to be in because you left profit on the table. Scaling helps to alleviate that, right? Because if you take out, just say half your position, just to make it simple, and it keeps going, well, you're still making money. You're still profitable. Yeah, you've banked some profit. But what happens if it bounces? You've capitalized, maximized your profit on that half the position, and now it bounces, and you're like, okay, well, you could stop out of the other half if you want, or if it's a trending stock and you think it's just a small retracement, then you can re-enter the position at a better price, right? You buy the option for $8 and it goes to 12. You take half your position out, it bounces back up, and now it's at 10. Looks like it's slowing down. It's going to roll back over. Buy it back at 10. You sold it at 12. You're buying it back at 10. You save $2 of wiggle that wouldn't have happened. So you increase your profits that way, right? So if momentum's still solid, then don't take as much off the table. I scale based on what the chart shows. If there's a lot of momentum, I'll leave more on the table. It's all about risk reward and how much risk do I want to leave on the table. And getting to that place where you're comfortable. You should, every single position you're in, the constant question in your mind should be, how much risk do I have? How much potential reward do I have? And am I comfortable with the amount of risk I have on this position? And if you can't say yes to that, then you need to adjust the position. Let's say you get 10 contracts of that option at $8. You got $8,000 on the line, technically. Even though if you stop out, let's say if you stop out, you're going to take $2,000 hit. But realistically, the stock could gap and you could lose the whole 8, right? But you got $2,000 of risk. Well, it runs to 12 and you're like, I got $4,000 of profit. Well, how much of that profit are you willing to risk? And what if it gaps and it goes to $6 overnight? The question is, if you sit there and go, I got $4,000 of profit, I don't want to risk it. I don't want to give it all back, because we've all done that, right? You get up a whole bunch, $4,000 or $5,000. The next day, the stock gaps on some kind of news, and your $8,000 initial trade is at $6,000. Now you're upside down $2,000. When you were up $4,000 the day before. You're like, freaking out, right? And they're like, okay, just get me back to break even. And then it gets worse. The mental games. Scaling helps that. If you take out half, right, you put 8,000 in, you take out half of it when it's at 12, that's 6, right? You've taken 6,000 off the table. Now, when you go back to your original position of 8, you only have $2,000 of risk left. So that position, that stock would have to gap massive for you to get to a losing position at that point. So you dramatically increase the odds of coming out profitable almost no matter what happens, right? You still have that $2,000 of your initial capital at risk. And if you don't want to have it at risk, then take 7 off the table or whatever number it takes. Say, I want my $8,000 back, and I'll let the rest of it ride. Right? It's like going to the casino, right? You're up $100 at the blackjack table. You started with 200. You take your $200, put it back in your pocket, say, I'm not losing anything for sure. I'll play with this $100, and if I grow it, great. If I don't, if I lose it, I'm going to be done, and I'll walk out break even. There's a million different ways to do it. So thank you, Jennifer. Well, yeah, it's the same thing that it took me a long time to figure out, that this business is about odds and it's about risk management. It's not about being right. You get on these Facebook groups and all these goofballs, and some guy's ripping on me yesterday about, he's saying he's right and he's been wrong the whole time. He's been calling for a bear market for a year and he's always wrong. And and it's funny because he's the one who's always talking about being right, because he's relative newbie, and it's like, I don't care about being right. I flat out said that a million times because this is not a business about being right. It's a business about odds and managing your emotions. Odds, risk management, and managing your emotions. That's what it's about. Picking the right stock, the right time, all this other stuff. I mean, those are important pieces, but they're not the most critical. The most critical is manage your mindset's the most critical. That's why I scale, because it helps this. Because what happens when you have that $8,000 position, it turns into 12, you take half of it off the table, you still have $6,000 sitting there, but from your starting position, you only have 2,000 at risk. Now, what do? You breathe easy. I'm not worried about it now. Why would you worry about it? And then, I mean, you can loosen the stop up even. If you think it's going to, wiggle around a whole bunch, if it's a really volatile stock, now you can just relax and chill out. It's an emotional management tool. So, local banks, not big banks, keep money in. Was I talking about bank? I don't know what that's referring to, Karen. I'm sorry. Yeah, when candle is shorter or flat, have fewer options to close out. Yeah. The other thing too, and I'll wrap with this. That well, if you want to see, look at a couple charts. We have a few minutes left. We can do that. I meant to get there sooner, but if we're in a bear market, which, like I said, it kind of looks like we're starting to, buy a little extra time. Depending on what your trading style is. If you're a swing trader and you're in and out in 2 or 3 days on every single trade, and you're buying, 30 days worth of time, maybe 60, you might consider, adding an extra 30 days to that. Then if it moves, well, and that's where scaling can come in handy, right? Then let's say it moves big and you can take half your position out, get all your capital back, or maybe more. I mean, if you got in Disney, I think I paid $1.60 for my Disney options. $1.36. They were long-term out of the money puts. They're right now at 450. I've already scaled out. I've gotten all my initial capital back and then some. So I'm already profitable. So no matter what happens left, no matter what happens with the little position I have left, I'm coming out ahead. So that's just one example. I got some other ones that are upside down. So every trade doesn't work out. In fact, I lose more often than I win. It's the big Disney trades it's the Disney trades like that. It's the ones that you're making 200, 300, 400% on. You lose 20 or 30% over here 5 or 6 times, then you make 2 or 300% over here. You don't have to be right very often. That's the risk reward component. That's the beauty of it. So, but yeah, consider adding extra time, because then if we do have those big moves, you can hang on longer. So, oh yeah. Okay, now I remember, Karen. Yeah. Well, yeah, that's one thing I mentioned. Where did my charts go? Where is my Omega? There we go. On the with the whole banking sector, I would be extremely cautious, especially trading bullish. I would be heavily biased only trading banks to the downside, because if one of them goes down, especially if it's a medium size or a big bank, I mean, y'all remember what happened, I assume, a year and a half ago, 2 years ago with SVB, and what were the other ones? 2 or 3 banks, big banks. They weren't small. Actually, I think it was bigger than, it was close to or bigger than JP Morgan, the 3 of them combined. I don't remember what the data was exactly, but it was a big deal. And the whole banking sector got hammered. And there's a lot of issues with banks. Commercial paper, their mortgages, they're not worth a lot, right? They have all this unrealized losses. Huge. Actually, I just saw that. That reminds me. That's another reason when you start to see the storms brewing behind the scenes that other people can't see, because you have a radar, right? And if I remember right, don't quote me on this, in 2008, the banks had $75 billion of unrealized losses on the books. And you see what happened in 2008. Apparently, that number right now is $700 billion. They have unrealized losses sitting on their books. Again, don't do your own research on that and figure out if that's accurate. I think it is. I think that was from Peter Schiff, but I can't remember. But dig up the numbers if you need to. Um, Even if that's a tenth true, that could get really ugly really quick. So if banks have that much unrealized and they're that illiquid, one little blip in the system, if they're that heavily leveraged, one little tweak in the system can throw everything off, right? So, and that's the hard part. I mean, you've all traded options, right? It's leverage. It's a form of leverage. And even a little tiny move in the stock can get you a huge return in the option. But a little tiny move in the stock the other way can get you a huge loss in the option too, right? That's the double-edged sword of leverage. And a lot of these banks are highly leveraged. So if that leverage flips and goes the other way against them, then they're in a world of trouble. So that's a possibility. So from a banking sector perspective, I would only, if I'm looking at bank stocks, well, here's Bank of New York. It's one on the list this week, right? We've got a nice double top that's formed, broke the midpoint. This thing's at an all-time high too. If I'm going to trade this though, I'm only going to trade to the downside. I'm not going to trade bullish on the banks. If I owned a bank, I would definitely have insurance on them just because of the risk in that entire sector, which would bleed to the rest of the economy. So it's going to hit everything. If that happens, if a big bank goes under, it's going to be catastrophic. I have very little doubt about that. So anyway, there's one right there. That's something else too I forgot about. The inverted yield curve. You probably have all heard about that, right? It's been inverted for 2 years, except that it's actually just uninverted. And that is, actually, I plan to start with that. I can't believe I forgot it. Now we're at the end. That is usually the telltale sign that we are entering a recession, because historically that's what happens. The yield curve inverts. And I heard somebody the other day say that it sometimes leads to recession. That is not an accurate statement. Every single time the yield curve has inverted, we go into recession. Every single time it's done it. There has been a recession that follows the yield curve. And when the yield curve uninverts is one of the telltale signs of when the recession starts. Historically, you go back and look and say, okay, the yield curve inverted here, and it was a year later, and it uninverted, and that's when the recession starts, right? So if you go back historically and look at the data from historical stuff, that's why it's hard, right now, we don't know when we're in a recession. When you're in it, you don't really know. Unless you look at anecdotal evidence and you see what's going on behind the scenes, and you have friends or family, or you know people, or you have companies like Intel coming out saying laying off a boatload of people. I mean, it's 15,000 people that aren't going to have a paycheck anymore. And will they find jobs elsewhere? Maybe. When you see the listed jobs, what's the name for it? I can't remember what they call it, but the jobs that are listed, job openings, that is at, if I remember right, it's at a, I don't know if it's a record low, but it's close, I think. So a lot of these companies have pulled back their hiring because they don't need as many people, or they don't want as many people. And part of it's AI. AI is having an impact on that too. AI has made certain industries at least more productive, so they don't need as many people. So there's a lot of what's the word I'm looking for? A lot of chaos happening under the surface, right? And it's not much different than a tsunami. You may not know it's coming until it hits the shore. And when it does, the question is, how big is it and how bad does it get? And as far as I'm concerned, that's where we're sitting right now. We're sitting at and there's lots of warning signs. That sad tsunami that hit, it's been several years now, but the one that they killed, 200,000 people, because they didn't have sensors out in the ocean that let them know it was coming. So I know in the Pacific Ocean, at least on the West Coast out here, there's all kinds of sensors out in the ocean that warn if there's a tsunami coming, all up and down the coast. I remember seeing it as a kid that, there's a tsunami route. They have tsunami routes. If a tsunami is coming, this is the route you take to get the heck out of Dodge, because you don't know how big or how bad it's going to be, right? They can guess at it, but nobody really knows until it's there. And I guess that's the overall theme of today is don't get blindsided by a tsunami. There's lots of warning signs out there that there's a tsunami headed for the shore, and head for higher ground. Be aware that is likely what's going to happen. The question that we all don't know the answer to is, how bad's it going to hit? How bad's it going to get when it does hit? And I've been saying this too for a long time, and I'll finish with this. I think part of what, not only is there the AI thing that has caused this craze, but the baby boom generation is flush with cash. Their houses are up in value, right? They're still there. The baby boom generation still feels wealthy because they've got lots of equity. Maybe their house is paid for. So God forbid they needed cash, they could tap the equity in their house or this or that, or they have their 401k and the market's kicking butt and they're feeling good. But what happens if the market does drop 10 or 20 or 30%? And all of a sudden that $400,000 or $500,000 that you have sitting there, you got a $500,000 retirement account that's supposed to help you in your golden years, right? And now all of a sudden it's only 350,000. Like, that's 150 grand that I could have used, right? And then your housing value, your house is worth $500,000, and now all of a sudden it's only worth 350 grand. You just lost $300,000 of net worth, and you're like, ah. So what happens if that whole generation, which is huge, that's where the bulk of the wealth of this country is. What happens if they start to sell and they panic and they're like, oh, I don't want, and they start to get out of stocks? I don't know. I mean, in my mind, I can see it, because if you got a huge generation that holds a huge percentage of wealth, starts to bail on that, they go, I want to go to cash. I want something that's safer. I want something that isn't a risk. Then all of a sudden you have this massive, run for the exits. So something to think about. It's just keep it in mind, because like I said, that's part of the tsunami that could make it a lot worse. And there's already cracks in real estate starting to show up. So at least in pockets of the country, there's places where inventory, because everybody's like, oh, prices aren't going to come down because the existing inventory is low. Well, all these apartments that have been built, only 47% have been filled nationally, right? So you got people building apartments right and left. Well, over 50% are still empty. So that's the other commercial thing that could drop, right? If you're building an apartment building for $7 or $8 million, it could, and you only have half of it filled, and you're losing money because you're paying this note. And now it's, commercial properties are adjustable rates. So they have to refinance every 3 to 5 years, 10 years, maybe. They don't do 30-year notes on commercial properties. So a lot of them are having to refinance into these higher interest rates. So their costs go up. That's why inflation's there, especially with housing, because they have to raise their prices because they can't be profitable. So now you have these commercial buildings that are underwater. They start losing value because they can't cash flow like they did before. So that $7 million apartment you just built is now only worth $4 million because of the interest rates, right? And then it's only half filled. So you can see, I mean, I'm just throwing out, all the different storm clouds that are brewing. And when you start to see all that stuff and you look at that data, it's like, uh-oh. So again, for me, it's not a question of, is there a storm coming? Is there a tsunami coming? It's a question of when it hits land and how bad it is. And my gut tells me, and just knowing what I know and seeing what I've seen, been through 2 crashes, I think it's going to be bad. It's going to be ugly. So mentally prepare for that. Be prepared for that to happen. And if it doesn't happen and the market keeps running, great, right? There's the old saying, prepare for the best, prepare for the worst and expect the best, or hope for the best. So, all right, I'm going to close with that. Any real quick questions? Thanks for being patient, Andrew. We'll just turn up the volume. I'm still going. All right. That'll get y'all chipper for the weekend, huh? You know what, though? That's the thing, is I'm ready. I'm excited about it, quite frankly. I'm not excited for the people who are going to get hurt. I don't like that. That part sucks. But I don't have any control over what other people do in their life. For me individually, I'm excited because I know what is possible if that happens. So thank you, Jennifer. And that was the whole point, is when I'm looking at the market going, this thing's right on edge. And, I would rather you all be prepared, and maybe you're cranky with me right now. Like, this guy's so negative. That's fine. Because in 6 months to a year, if you are trading the bear, and at least you know how to take advantage of it, or at least protect yourself so you don't lose money, or at least not lose less, then hey, in a year you'll be like, I remember that guy. I'm glad he said that. So, all righty. You too. Thanks, Kevin. Appreciate that. Everybody have a good weekend. And I'm going to be in Montana next weekend, so should be a good time. Get away for a few days and relax, have a little fun. Of course, I'll have to bring the laptop and keep some trades active, but or at least manage what I have. So I probably won't be activating any trades, but anyway. All right, y'all take care. God bless. We'll see you soon. Bye.